Hi, thank you for joining me today. We have a special guest, Ron Ricard with IPX 1031. Thank you for joining us today, Ron.
Thank you for having me.
Sorry, that was the feedback. We're gonna our topic for today are 1031 exchanges. We're going to be going over some of the introduction and basics on it, and continue on to some interesting strategies that you can utilize with the 1031s. We have 11 questions that I'll be asking Ron, and we'll have discussions about those. And if anyone has questions, please add them to the chat, and if we have time, we will try to answer them. All right, so we'll jump right in. What is a deferred exchange?
1031 just refers to a section of the tax code that allows you to sell investment real estate and buy replacement investment real estate. And in doing so, you get to defer paying taxes on the profit that you've made. So you have a rental house, you want to sell that and buy a duplex. You list the property. At the close of escrow, the money comes to a third-party intermediary. Then that company like us, then you buy the new property and we send the money to the title company on that side. So you're selling investment real estate, buying investment real estate, and that allows you to defer paying taxes on the profit that you've made.
Exactly. And what qualifies, right, as like-kind realty under these rules that you kind of talked about?
Yeah, these are frequently referred to as like-kind exchanges, but that's a very misleading term.
Yeah.
You can buy and sell any kind of investment real estate for any other kind of investment real estate. So you could sell a rental house and buy a shopping center. You can sell a farm and buy an apartment building. You could even sell bare land and buy commercial or residential real estate. It's any kind of investment real estate for any other kind, anywhere in the country. So you can sell in California, buy in another state, or vice versa, and you are still deferring both state and federal taxes.
Exactly. So I'm just going to reiterate what you just said. It just has to be from investment real estate to investment real estate.
Exactly.
Any type of investment real estate. You can go from commercial to residential to land or vice versa. And it, as long as we'll get into this on the next question, this feeds right into the next question. Well, what type of real estate is not eligible for these kind of exchanges, 1031 exchanges?
Well, there are two main categories there. The first is property for personal use. Obviously, your primary residence is not investment real estate. Now, you might think of it as an investment, but the IRS doesn't. So your primary residence is not considered to be investment real estate. Similarly, a second home is not considered to be investment real estate. So property that is for you or your family to use, again, personal use, not investment. Lastly, the other kind of property that does not qualify is property that the IRS says is purchased for resale. And typically we think of either development or flipping. You know, you buy a beat up old house, you fix it up and you sell it. To you, you made money on the property, but to the IRS, you bought the property with the intention of it being a short-term hold. You basically bought it for resale. So that does not qualify for 1031. As a rule, investment real estate is real estate that you get rental income from or real estate that you run your business from. Bare land qualifies because it's considered to be held for appreciation purposes, but that's what we're talking about, investment real estate.
Exactly. So we kind of talked about deferring taxes. So the question I would have is, or a lot of my clients have is, well, when is like gains and losses recognized, and like when are capital, like how does, like what's the intention, like capital gains taxes, right? Like,
right. So I think
let me preface this by saying neither Ron nor I are accountants, right? So please consult with your accountants on the tax consequences. However, we have a lot of experience in this and talking with accountants, so we can give some general guidance, but talk to your qualified tax professional. There you go.
Very true. Now, there are a couple of questions in there. The first one is the 1031 is only deferring the taxes, does not eliminate the taxes. So if you sell a property and buy a replacement property, you can keep exchanging, but the advantage of doing the exchange is every time you do the exchange, instead of giving the government 30 or 35% of your gain in the property, you get to use that money instead of them. So you get to use the money instead of the government, which most people like. Ultimately, also, you own this real estate the rest of your life, in which case, if you do, your heirs get what's called a step up in tax basis, and all of your profit in the property disappears. So, there's an advantage owning the property the rest of your life that way. Should you ever cash out on the property, now you're looking at paying taxes on the gain, on the taxable profit from the property. And for most people in California, that's going to be somewhere between 25 and 35% in taxes.
Yeah. So I guess that, and the next step in the process is, what is the role? You briefly talked about this in the first question of what is a deferred exchange. So the question is, what is the role? I think you briefly went over this already. What is the role of the qualified intermediary in the exchange? So in this case, it would be IPX 1031.
Right. Whenever you do an exchange, the IRS requires the use of the qualified intermediary, and that's a company like ours. And so again, we are a required part. And the main thing that we do is that we hold the money. When escrow closes, the funds get transferred to the intermediary. And then when you buy the replacement property, we send the money to the title company or closing attorney on the replacement side. So you're selling something, you're buying something. I view what we do as being like the escrow between the escrows. But we are required, because if you touch or control the money, you pay taxes. And that's why the money has to come through the intermediary.
Yeah. And then on that front, like, what are the kind of time limits, right, in the exchange process? Because there's some very, very important milestones, right, that we have to meet to qualify for the 1031. Otherwise, we'll be disqualified, right, from utilizing this amazing part of the tax code.
Right. And actually, the timelines are probably the most important thing to know when it comes, or among the most important things to know when it comes to the exchange. And these are actually in the tax code, so they're not flexible. It's 45 days to identify what you are going to buy, and 180 days to close escrow. So 45 days to tell us exactly what you are going to purchase in replacement, 180 days to complete the transaction. Now, both of those clocks start the day escrow closes on the sale of your property. So the longer you're in escrow, the longer before the clock starts. But that 45-day clock really is the critical one, because you need to know what you're going to buy within those 45 days. Technically, you don't have to be in contract, but you really should be, because the last thing you want to do is identify properties and then on day 47 have them sold to somebody else, and then you're really out of luck. So really, by day 45, you want to be in contract on what you want to purchase.
Exactly. That's the advice I give all my clients that are doing 1031 exchanges. We have to be in contract before 45 days, to make this happen. So I know there've been a lot of big changes in the tax code from the previous administration and even the current administration. I know there was some discussion about 1031s, but what is, I guess, the latest update from you on the what the federal government and even state government are doing to talk about, I guess, federal, right, for the IRS? What are the current discussions about 1031s as of late?
Okay, so back in 2017, the last time we had a major change in the tax code, they did eliminate 1031 exchanges for everything except real estate, because we used to do exchanges on equipment, on what we call personal property, and those exchanges disappeared as of 2017. So that was the last major change to 1031, but nothing changed as far as real estate is concerned. Now, there has been some proposals floated to limit 1031 exchanges, or even eliminate it completely, but those have gotten nowhere. There has not been any bill proposed in front of Congress that has any impact whatsoever on 1031 exchanges. I kind of view this as, I'm not looking for a new job. So there's really nothing going on right now that is jeopardizing the integrity of the 1031 exchange.
Perfect. That's things that we want to hear, right?
Yeah.
This is a very important part of in like for my investor clients, right? On that, on another question about that, the 1031, because we've been talking mainly about selling first, then buying, right? All the discussion we've had up to now so far. Can you do the opposite? Is it possible to buy first, then sell on a 1031?
Yeah, there is something called a reverse exchange where you buy first and then sell. Note that what's important is when you close escrow. So if you go into contract to buy something, but you're able to sell yours first, then it's a regular exchange. But if you do need to close escrow on the replacement first, that's a reverse exchange. I don't want to go too deeply into it. It is a much more expensive transaction, whereas a regular exchange will cost you less than $2,000. A reverse exchange is probably going to cost you $7,000 to $10,000 and sometimes even more. So it is much more expensive. Obviously, you have to have the money to buy the property also because you haven't sold your property yet. So in a reverse exchange, we actually take title to the property for you using your money. So again, it's a more complicated transaction. If you have funds to make the purchase, it's usually doable. But again, most people will sell theirs first and do it as a regular exchange.
Yeah, so if you want further details on that, right, I can put you in touch with Ron and he can walk you through your specific case on that.
And there are different ways of structuring them. Also, a lot of it depends if it's residential versus commercial. I mean, there's a lot of things that factor into a reverse exchange. So yes, it's better to know your specific situation before to go over how it might work for you.
Yeah. The next question: can you do a partial exchange?
So there are, when you say partial, there are two different ways to look at partial exchanges. First off, do you have a property that qualifies for both? For example, do you own a duplex where part of the property is primary residence, part of it is investment property? Because obviously in that situation, part of the property will qualify for your primary residence exemption, part of the property qualifies for 1031. So in that case, you could do an exchange on whatever percentage of the property you are showing as the rental or investment portion of that property. The other way you could describe that is, can you do an exchange and not reinvest all of the money? One important thing to know in a 1031 is that to defer all your taxes, you do need to buy equal or greater in value. So if I'm selling for $1 million, you want to buy for at least $1 million. Now, sometimes people will say, I only want to do a partial exchange. I want to sell for $1 million, but only buy for 800,000. Yes, that's okay, but you're going to pay tax on that difference. Yeah. So if you do spend less than what you sold for, then you pay tax on whatever that delta is. But if you want to defer all of your taxes, you want to buy equal or greater in value.
Got it. Can you relinquish the old property? Can the relinquished property, the property you sell, can you sell it to a family member?
It is perfectly okay to sell your relinquished property to a family member, but it's a problem if you buy the replacement from a family member. There are restrictions in the 1031 code with transactions done with related parties. Obviously, your family is related to you. And, again, selling to a related party, the IRS has pretty much said, not a problem. Buying from a related party is a problem. Again, lots of nuances to that. And I would need to know people's specific situation before they want to do that. But if your goal is to, sell your rental and buy your daughter's house from her, it's not going to work.
Got it. What are some of the some of the common mistakes that you see, like with clients that are trying to do 1031s? I would guess the timeline is one big one.
Absolutely, the timeline is the biggest thing in terms of making sure, because these are, I guarantee you, the fastest 45 days of your life.
Yep.
So that's going to be the thing. Another common mistake is people don't realize they need to spend everything on the next property. A lot of people think you only have to spend your profit or your equity. No, you have to spend everything on the next property. In terms of what we haven't spoken about, one important thing to realize also is it has to be the same taxpayer buying and selling. So if Eric sells, Eric has to buy. You can't give the money to your daughter to buy the replacement property. And that becomes very relevant if you own property with other people, because if you own the property in some kind of entity like a partnership or corporation, it has to be that same entity buying the next property. If you want to, dissolve the partnership, that's a problem. So how you own title, how you report the property on your tax return needs to be consistent with when you're selling and when you're buying.
Right, and then so you can consult with your attorney, right, to structure the entity, right, if you want to, sell shares or whatnot of the entity, right, as long as the entity is making the transfers, right?
Right. I mean, a lot of it depends on really what you're trying to do. And what I always say is with enough planning, you can almost get anything done. But if you call me, like I get all the time, hey, I'm closing escrow on Monday and we're dissolving our partnership and we're doing X, Y, and Z, it's like, nope, ain't gonna work. If we planned ahead of time, probably would have been a way to make it work. So the big takeaway that I have for you about this is, if you are doing something, talk to us early in the transaction. If it's something especially that you think you're going to be changing the ownership structure of the property, call me before you even list the property, because there are things you may need to do and not sell the property for a period of time afterwards.
Yeah, that's a big thing I see from my clients too, is like, I highly recommend, engaging Ron and your realtor early on the process if you're trying to do a 1031 versus like you're going to close in 5 days on the first property and like, oh, I would like to do a 1031. Because like you mentioned, and I would say that's probably like the biggest takeaway I would say from this is that 45-day identification timeline is key, and it comes up very fast.
Yep, exactly.
And so and then the other thing you mentioned, planning is extremely important, right? So like understanding what your goals are in doing this is really just essential to have a successful and stress-free process versus trying to do something at the last second. It's very challenging, especially on something like this. All right. Let me see if we have any questions. Don't see any questions. But I'd like to thank Ron for joining us. Ron from IPX 1031. We've worked together a few times already successfully. Yep. We have one closing tomorrow, actually. So thanks for joining me, Ron, and hopefully we have you again.
Thanks for having me, and look forward to continuing to work with you and your clients in the future.
All right. Have a good one, Ron.
You too. Thank you.